on talking about demystifying the displaced moving average. That's a mouthful, isn't it? Now, tonight I've got one or two special presentations that I put together for you that I'm going to share with you in the webinar. In the recorded version of this webinar, you'll see a blank space because the webinar system doesn't record over another recording. So if you want to see these presentations that I've shared with you separately from the webinar, if you go to YouTube and then go to look for the channel, don't go doing a search, look for the channel that's called Forex and CFD Education, just like I have it on the screen. And then look under the playlist for moving averages. Also tonight, if you notice on your screen, I've got two handouts for you. My moving average guide handout, which is put together for you, covers all moving averages, how to use them, what the differences are, for you to use as a reference material after the class is over. I've also given you the investing.com's Introduction to Technical Analysis ebook, which covers moving averages as well as all aspects of technical analysis. It's a great ebook. It's got lots of in-depth material for you. So click on the little download buttons that you see right on your screen in the handouts. There's nothing you have to sign up for, nothing you have to do. Download it directly to your computer, whatever device you're using that, and then move it around when you want to, or look at it at your convenience, because you can access these in the recorded version of tonight's class. Now, in tonight's class, I'm going to use the term security, but I might use the word Bitcoin. I might use the word Euro. I might say Apple. Okay. But I'm referring to all publicly traded investment instruments. Okay. It just gets very boring saying security, security, security over and over again. Similarly, I intermix the term investing and trading, because all of us here most likely are looking for CFD and Forex information. We're traders. We're looking for short-term investments to make profit on moves, small moves in the market, where a longer-term position is taken by an investor when they want to hold on to an asset. We know the difference between trading and investing. I know the difference. The fact is, I intermix the terms in class because basically when I talk to you tonight about displaced moving averages, the concepts hold true for any type of trading or investing. But it also gets very boring just saying trading, trading, trading. So I mix them up. Now, ultimately, all traders ask, should I buy today? Should I buy tomorrow? What will the prices be in an hour from now? What will they be tomorrow? What will they be next week? Would investing or trading be easy if we knew the answers to these seemingly simple questions? But see, I don't have a crystal ball and I don't have a Ouija board. So if you're attending this class in the hopes that technical analysis, and especially moving averages, has the answer to these questions, I'm afraid I have to disappoint you early. In fact, nobody does. Nobody can tell you what the price will be an hour from now or tomorrow or next week. We can tell you what the momentum is. We can tell you about the market psychology, but ultimately price has its own mind of doing its own thing. So however, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I have good news for you. It sure will. Now, an important step when evaluating a trading plan or a method is to comb through the tools currently employed by a trader to determine exactly what the new approach might bring to the table. Now, tonight, we're going to be using my buddy Bob as an example. Okay, so to illustrate the process of finding the right tools, we'll use the experience of one of my clients, buddy Bob, who was looking for a technical trading tool that was easy to use, did not require intraday monitoring, and could help him become more successful. Now, Bob is market savvy, but tired of using the same indicators that everyone else has been using for years. He wanted something unique that might give him a competitive edge. While there are hundreds of methods, indicators, and strategies out there, my finding on one approach might help you identify other tools. So in Bob's case, he's been using moving averages of various durations. However, Bob's moving averages weren't working out so well. So while moving averages filter out the random noise in price data by smoothing price fluctuations due to its construction, this technical analysis indicator lags behind the market and is therefore always late in forecasting a trend change. Now, I'm going to assume that most of you out there already know about moving averages. A moving average is simply an average of, in most cases, the close price over the last whatever determine you want the average to be. So if you said, I'm a short-term trader, so I'm going to use, say, 10 periods, and I'm looking at a 15-minute chart, that would be back 10 candles or 10 bars. You'd add up all the closes for the end of each one of those trading segments and divide it by 10, and you would get your moving average. Okay. Now, that's a real basic piece of information. Okay. It's very simplistic, and basically we say that a simple moving average, and that's what it's called, an SMA, helps us take the noise out of the markets. It helps us see what is happening. Because as you know, price bounces up and down, up and down, up and down. So a simple moving average can help you take the noise out of the markets. But a lot of traders say, well, I need something that's more adjustable because I'm going back 10 periods, but the price over the last 3 periods just soared straight up or fell straight down. And a simple moving average doesn't take into consideration these radical moves in the last few bars. So a lot of us use EMAs, exponential moving average. An exponential moving average gives more weight to the more recent time segments. So say hypothetically you were looking at gold, and gold was trading 10 segments ago at 1250, 9 segments it closed at 1250, 8 segments it closed at 1250, 7 seconds, 765. But in the last 2, it closed at 1275 and 1280. Well, that's a very important piece of information because the price of gold had been steady and then it started to jump up. If you're using a simple moving average, it doesn't take that into account, where an EMA or a weighted moving average takes that into account. Now, the time period you use, whether you're using a 10-day moving average or a 20-day or a 30-day, that is important because the longer the duration, the less information you get or the less sensitivity you get to current price moves. But that's a combination of strategies and personalization and customization that you need to decide. So one of the problems, though, with no matter what type, and actually let me pop them up on a chart and show them to you. Hold on a second. Okay, so a simple moving average, and let's make this a 12 period just to match the EMA. Okay. I'm just picking 12 because 12 is a good number for a moving average. There are some standard numbers for moving averages. You know, a 10, a 12, a 20, a 30, a 50, and the shorter the period, you should use a shorter period to fit your style because we're trading in very short markets. But just for class demonstration, we're going to use a 12 period moving average, a simple moving average. And I'm going to drop that on your chart right now. And you'll see that that is the gold line. Let me make this gold line a little bit thicker so you can see it a little bit better. Okay, so that is the gold line that you see on the chart right now. Oh, hold on a second. Okay, there we go. That's what we see on the chart right now. Now, this simply smooths out the price action. Doesn't tell you much about the trend or trading. Although we have what we call green light, red light. In other words, when price is above the moving average, we should be looking to buy. When price is below the moving average, we should be looking to sell. And this is regardless of whatever you're doing. This is just telling where the trend is. And this is called red light, green light. Okay. But tonight we're here to talk about displaced moving averages. So we need to move through this pretty quickly because we got to get on to the displaced moving average. Now, an EMA, an exponential moving average, is now let's change the color of this because we don't want two gold ones. We'll make this orange. No, too close in color. I just try to put them up so you can see them a little bit better. Let's make it a dark green. Okay, so the green line is the exponential moving average of the same setup, 12 periods to close. And as you can see, the exponential moving average kind of hovers closer to the price movement. Okay, and is more realistically shows the movement of price because we've given more weight to that most current move. So you can, as you can see, at the current, let me get my marker up here for you. See right here, price has really dropped, and the EMA has stayed a lot closer to price, where the SMA was not as responsive to price. So the EMA gives us a little bit better information. You can see here, when you had this rapid drop, it wasn't taken into consideration in your EMA because EMA was going back and averaging all of this period, as opposed to the SMA, where the EMA was using the same period but giving more weight to the more current prices. So it showed the drop faster or reacted better to the price. And that's the difference between an SMA and an EMA. But the fact is, these are called lagging indicators. A lagging indicator is a term we use in finance. It's not a bad term. You know, we're not talking about he's lagging in education, so that's bad, or he's lagging in his growth. That's bad. Lagging and leading are the two terms we have for market indicators. And leading means it predicts a change in the market, where lagging confirms a trade in the market. And a moving average is a lagging indicator. So it's not going to help you get a signal in front of yourself. It's going to confirm something. So that's why a lot of people try to use a moving average crossover strategy. And unless you respond very, very quickly, it's really not a good indicator, because when the two prices cross and give you a buy or sell signal, it's actually a little bit late. Okay. So traders for a long time have been looking for ways to use moving averages, but get them to be more reactive. So first, let's talk about, I think I have, I'm going to share with you a little presentation on using moving averages, and then we're going to go over and talk about how we resolve this problem.
to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video where we showed you the most commonly used time periods when analysing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal.
So, there are many ways, as you can see, to use moving averages. But it doesn't change the problem with it being a lagging indicator. So a lot of us have adopted, instead of using a simple moving average crossover strategy, we've adapted to using an EMA, an exponential moving average crossover strategy, because by using the exponential moving average, we're getting a little bit less lag because we're now giving more weight, as I said earlier, to the more recent time frames. But this still doesn't overcome the lag. And we want something that's in front of the market because we want to be trading in front. We want something that's going to give us a clear-cut signal ahead so we can get prepared, not that we get the signal and then we're scrambling to try to figure out how to trade and make that trade. And so we're always looking for what's called a leading indicator. So a type of moving average that attempts to overcome the lag is the displaced moving average. This is a fairly new concept. it really wasn't available or easy to use until we got these new modern computerized Java charts and HTML charts. So ordinarily when computing moving averages and using them in some sort of crossover or oscillator approach, we end up dealing with this lag time, displacing a moving average, and it's exactly what the word is, displacing. We're not changing any calculation. We're not changing any strategy. Displacing a moving average is the practice of shifting it forward in time. This turns the moving average into a leading indicator, as it is now predicting where the trend will be in the future rather than telling you where it's been in the past. For example, if the moving average is placed forward in time by 5 periods, and you believe that the trend is going to hold relatively steady, then you have a visual marker of where price will be if you're correct. Okay, that's a mouthful, isn't it? So we're not changing the calculations at all. What we're doing is we're taking the same moving average. So here we have on this chart, we have the EMA. It's in blue. Okay. We're not recalculating that EMA. We're not changing the math available in that EMA. What we're doing is we're displacing it on the chart. Okay. If we were to take the calculation for the EMA for this price range, this price bar right here, okay, we would also put that calculation right below that bar. But if we were to take that calculation and push it forward 5 candlesticks, because those candlesticks haven't happened, we push that and put it on our chart 5 segments forward, okay, we start getting something interesting. We're not, like I said, we're not changing calculation. We're just putting that dot on our chart a little bit more forward. And we're starting to see that this is going to more accurately give us the support and resistance in the future, as well as where price should be trading in the future. So a displaced moving average is simply a shifted forward in time, turning it into a leading indicator. It's like we've got into some science fiction movie and we've displaced time, we've pushed it forward, okay, but we haven't changed the calculation. So if you shift the regular moving average on your chart to the right or left, you get a displaced moving average. Many trading strategies use displaced moving averages as an improvement over regular moving averages. When this is done, the lag is evident on the chart as the market trends higher, for instance, and the moving average trails below the actual daily prices. Similarly, when a market reverses abruptly and starts to trend lower, the moving average lags above the actual price and briefly may even continue to increase in value as the market is declining. Whereas using a displaced moving average, you will see where the price should have been. So on this chart, what we're looking at on the screen, in the black line, we're seeing actual price. This is a bar chart. I mean, a line chart. So the black is the actual price of the asset. The blue line is the moving average calculation of the price. And the gold is simply that same calculation displaced. It's pushed. All it is where we put the dot on the chart is pushed forward. That's all it is a mechanical system of putting it more forward on your charts. So the assumption behind displacing moving average values forward in time is that the future period's actual moving average that has not yet occurred will in fact be equal to today's moving average value. This is, of course, a very simplistic forecast of a future period's moving average value. However, it is a forecast, not just a linear extrapolation from past price data such as you achieve by extending a support or resistance line to the right of the price chart. So let's go over to a chart and let's see if I can explain this to you better on our live chart. So right now, let's get rid of the simple moving average. And we've got our exponential moving average on the chart. We're looking at a 12-period EMA on a 1-hour chart of the euro US dollar. So that's giving us a lagging indicator, but it's fairly accurate to price, but it's not really telling us anything about the future. It's giving us the green and the red by, to buy above and buy below. It's helping us see the trend, but otherwise it's not giving us any help in our trading. If I were to take this EMA and all I'm doing is using the same calculations, but I'm going to shift it forward. I'm going to offset or displace it 5 time frames. Okay. So if I click on here and put it on the chart, okay, what happens is you see now that EMA line, which is now the blue line, displaced one, it's the same exact line, same movement, same calculation, but it's been shifted forward. So instead of it being here, it's here. So it's like you took something up and just moved it forward, pushed it forward 5, right? So now this is helping us predict where price would be moving forward. And again, just by putting in moving average in your chart doesn't really help you much. But if you're going to employ that with a crossover strategy, so say we're going to take an EMA for an EMA for 12 periods, and we're going to take an EMA for, say, 24 periods. Let's take 20. 20 is a very popular EMA. We're going to shift it also forward 5. Okay, now we get we get a indicator that is now predicting the future. So now notice we're getting at price cross right here. We're getting the 2 moving averages cross over, but it's now crossing over in front of price. So what we're getting is a buy signal here at this price level and at this time in the future. So now we have something that's in front of the market instead of behind the market. So as you can see, when we got the crossover here of the displaced moving, and look how accurate that is. Okay, it's telling you the price is going to fall. You got the crossover, and look at that. Okay, you're getting a lot more accurate. You're not just getting a lot more accurate signal. You're getting a more responsive signal in front of. So here we got the buy signal here. Look at where price went. Instead of getting it here with, behind the fact, we got it in front of the fact. So if we would have bought, you see here, look at this jump here. We got the crossover because we were looking at this in the future. We would have seen this crossover before these prices bars ever existed. So we're not changing the strategy. We're not changing the numbers. We're not changing anything you would do using moving average. We're simply displacing them and moving them forward. So we're not rewriting your strategies. We're not changing anything. We're just changing where the action falls on your chart. Let's go back to my PowerPoint and let's see if I can explain this a little bit better for you. Now, more research and testing of this substitute approach needs to be done before a recommendation can be made, because you need to apply it to your current strategy or your current way, and then determine how far forward you want to push it. So now you're not just customizing what you're using for your crossover strategy, or using a 10-20, using a 30-60-90, but now you want to determine how many time frames you want to displace it. So when the predicted moving average for the future date is greater than today's actual moving average, the market can be expected to move higher throughout that time. Conversely, when the predicted moving average is less than today's actual moving average, the market is expected to move lower. The difference between the two moving averages measures the strength of the expected move. For example, a predicted 10-day moving average for 4 days from today is compared to today's actual 10-day moving average. If the predicted average is greater than today's actual, the market is expected to go up. When the difference reaches a maximum positive number and starts to shrink, that's an early indication that the bullish trend is starting to lose strength and that the market is about to top out or soon turn downward. So then, if the predicted average does cross the actual moving average from above to below, so that the difference between them shifts from positive to negative, this confirms that the market is ready to make a top and reverse. Depending on an individual trader's risk tolerance, as well as his trading style and objectives, he might tighten his stops or close out a trade once the difference narrows even slightly. So in that case, instead of using a crossover strategy of two displaced moving averages, you're using one displaced and one not displaced. And you're using the difference between those displaced moving averages. Now, predicted moving average over here clearly leads twists and turns in the actual 10-day period. A more aggressive trader might reverse positions prior to the cross actually occurring. Other more conservative traders might wait for the crossover to take place before putting on a position. So while it is similar in many ways to the typical moving average crossover methods that we all are familiar with, by forecasting the moving averages, Mendelssohn, who's my buddy Bob, has found a way to overcome their lag and effectively transport this popular trading indicator from a trade lagging into a trade leading indicator. So using the same technology that allows the moving average forecast, this approach can also predict the next period and the next day's high and lows of the target market. Precise accuracy is not necessary to help traders identify entry and exit and sell and set trailing stop losses. In Bob's case, he is working with a relatively small account and considers himself a conservative trader, so he adopts stops. Depending on each market and depending on each trader's own risk tolerance, the dollar amount of the stop can differ. Rather than using a fixed dollar, Bob can use these high and low predictions. For instance, the predicted high-low range can be used on subsequent days to move his trailing stops. So if Bob is long the euro and based on the forecast, the target market is expected to continue to keep rising, he might set a stop a few ticks below the predicted low to act as that support level. Now also, traditional support and resistance trend lines are used by too many traders, and their stops are often bunched together and frequently get hit. Using a predicted high or low to set a stop may lessen the likelihood of being stopped out during intraday price swings. Look at the actual euro chart over here and the predicted highs and lows. When doing that, what we're doing is we're putting two displaced moving averages on our chart and using the high above the top one and the low against the bottom one. So what we end up with is a channel using those two displaced moving averages. So how do you recognize which displaced moving average you need? The answer to this question is quite simple. It's all trial and error. The thing about this, it is customized. You have to test it yourself and figure out how you're going to add this or change your trading strategy and how you'll use it to find your stops. So below here, we see an example where we have a 20-period moving average displaced by 3 periods. As you can see, there are some swing lows which confirm the displaced moving average level and use it as support. So you see that on our chart over here on the right. On the other hand, there are a few where the price closes below the displaced moving average. This means that the moving average might be better to be displaced in the opposite direction. Therefore, let's shift the moving average forward. We change our displaced moving average from 20 and 3 to displacing it to moving it to 20 minus 3. Because that's another thing we can do is we can shift left or right. Most of us automatically shift to the right, adding periods forward. But there's been some interesting testing about shifting it to the left instead. So as you see, the bottoms of the uptrend are much better suited with the displaced moving average at the 20 minus 3 in comparison to the prior configuration, because you have to adapt. How can you adapt displaced moving averages indicators to your strategy? Well, we're going to go through a couple suggestions on how DMAs can be combined with other trading tools. And this will give you some idea how you combine the indicator with your existing strategy. 1, simple moving average, displaced moving average, and momentum indicator. Combine the simple moving average with the same period displaced moving average and a momentum indicator. So here you'll see the screenshot of the Euro New Zealand dollar compared on a 30-minute chart. So on the chart, we are displacing 2 moving averages, the SMA and the DMA. Okay, and we've added a momentum indicator below. So what we're hoping to accomplish is that looking at the momentum, we can identify a divergence with price, and then we can use the moving averages to validate the trading signal. So in other words, when price diverges from the momentum indicator, there's a strong bearish divergence between the momentum indicator and price action. And if you don't know what divergence is, you need to come to our class on divergence. So the momentum indicator breaks the 100 level line in a bearish direction, which gives us a second bearish signal. For those of you not aware, a break of 100 on the momentum indicator is an indication that bears are in control of the indicator. The DMA breaks the SMA to the downside. Okay, so in other words, we have our divergence from our indicator down below. Here we have the SMA and the EMA, and when we get the crossover, we got the bearish divergence, the bullish divergence, and then we have the crossover. That's then telling us we should go enter a short trade at that point. And if you notice, it's in front of the market. When we got that crossover, it's before the market tipped down. So the price divergence with the momentum indicator breaking 100 and the DMA breaking through and the SMA led to the bearish sentiment. These signals triggered a short sell at the yellow circle on the chart. Number 2, we can combine a positive and a negative displaced moving average, while the same period simple moving average and a parabolic SAR. So in this case, we're using our parabolic SAR as our indicator, okay, and we're using 2 different displacements. We're using a positive displacement and a negative displacement. So we're combining a positive and negative displaced moving average with the same period simple moving average and a parabolic SAR. So we've got 3 different moving average lines on here, and then you see the dotted line for the parabolic SAR. Now, because we are using 3 moving averages, 2 DMAs, we're using a DMA at 30 minus 10. That's our magenta line here. So we've shifted that back 10. We've displaced it negative or back to the left 10 time frames. And we've taken a 30 period and added or moved it forward 10 time frames. That's the blue line here. So we've created a displaced moving average channel. What we've done is we're using that to build a channel. And that channel and the price movement within that channel can give us some information. We will now explore when there is an opportunity to sell the security short. So identify the trade entry. First, we wait for the security to break the parabolic SAR to the downside. This gives us a signal that the market sentiment is turning bearish. Then we wait for the cross beneath the DMA. Okay, so we would wait for one to cross the other. And once in the trade, you simply hold the position until the security crosses back above the SAR. One point to note with this strategy is that you need a strong trend to capture that move. Above all, this is the hard part about trading. When you realize that you have 50% of your trades which float sideways. Okay. But it's only takes 50% to find trends that are moving, because you should only be looking for assets that are trending up or down. If an asset's not trending and you don't see a clear-cut trend, move on to something else. And last of all three is displaced moving averages and simple moving averages with stochastics or RSI. That'll be the most popular. So what we're seeing here is in our stochastic or RSI, we're getting overbought and oversold indicators. And remember, an overbought or oversold indication only tells you the momentum is waning. So when price is moving up, it is moving up too fast, and it breaks above the 70 or the 80, whatever you're using on your oscillators, it's telling the market's overbought. That's just telling you the momentum is slowing down. Okay, it doesn't. An overbought market can stay overbought for a long time, but by combining that with a crossover trade with a displaced moving average, you'll get also now the exact entry point ahead of the market to buy or to sell. So when using the oscillators to determine trade opportunities as a result of the crossover of the moving averages, this is by far the busiest of the strategies mentioned. You will need to determine if so many indicators in your chart create sensory overload. We wait for the RSI and the stochastics to enter an overbought or oversold area. I tell everybody never use the two indicators. Use one or the other. RSI and stochastics are both momentum indicators. Okay. They both are bounded oscillators. But when you use one and you get the overbought or the oversold indication, then we wait for the leading DMA to cross the simple moving average. We then open a position once all the indicators are aligned and provide the same signal. We close our position when the RSI goes to the other extreme or whenever the moving averages cross one another. So those were the three different suggestions we had for you. And that's all I can tell you tonight about displaced moving averages. Our use of displaced moving averages as part of our trading strategy has a few uses. It can give us our bias in regards to direction. It can be used as a trigger into a trade, and it can also be used as a setup indicator. You have to admit that something so simple as a moving average can have such a wide range of uses. And then you can combine it to build channels. There's many different areas, but there's same strategies you would have used for EMAs or SMAs. It's just displacing it forward. So we can get a lot of information to form the basis of a trading strategy by looking at the chart, especially for our trading biases. The secret is to use a higher time frame as your bias for trade direction and a lower one for your actual trading. So there are lots of strategies that can be explored with the use of the DMA. So the question is, are displaced moving averages a good trading strategy? Well, this is a simple trading strategy, especially if you're a swing trader, markets like Forex. It's clear-cut entries and trend signals, which many traders have a problem with. I think the displaced moving average channel frames price quite well and can focus your attention to certain locations on charts to look for trades. It lends itself very well to support and resistance trading, as well as highlighting price compression that is needed for good breakout trades. Trading signals are also generated when the DMA and the MA cross. If the DMA crosses above, a buy signal is generated. Conversely, if the DMA crosses below, a sell signal is generated. Okay, that's a very simplistic strategy. And if the strategy you're using was always a moving average crossover strategy, all we're doing is, like I said, turning a lagging indicator into a leading indicator. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. I hope I gave you something to think about, because DMAs are fairly new to the market, but they're becoming extremely popular because we used to didn't have charts that we could do this. And again, I'll show you almost all charts that you're using on your brand, on your particular platform provider or whatever chart service you're paying for. If you just look up the moving average, the new ones today will give you what some will call it displaced, some will call it shift, some will call it offset. And you simply pick how many periods you want to offset it. That's it, and it'll do the calculations, put it on your chart, and put it forward for you. There's nothing you have to do. So this makes it easy. You just have to make the decisions. So thank you very much for joining us tonight. If you want to learn more about displaced moving averages, you go to alvexo.com, alvexo.com, and sign up for their Trading Academy, and you'll find lots of information on moving averages and displaced moving averages. So once again, thank you very much, and have a great trading week. Good night now.